Now, coming down to the statement of cash flows. Now, what is a cash flow and why is it important? Now, your business might be incurring losses. You might not be having a positive income. It is not a good thing, but it may not even be a bad thing. Reason being is like, if you just started your company and you have a very brilliant business idea, but right now, I mean, like you cannot expect a positive income in the first month or first year, or maybe like, you might be incurring losses for the next 5 years and you are ready for that because you have to develop your business. So your income might be negative. But the thing is that your cash flow is extremely important because cash is considered to be the blood of the business. Okay, you might be very healthy and muscular, but if you get injured and you lose your blood, you can be in serious danger. On the other hand, your income might be weak. I mean, like you may not have strong muscles, but if your blood is good and your blood test results are positive and like good, I mean, I don't know what the positive you mean in medical terms, but positive normally is a negative sign. But anyway, if everything is good with your blood, you're still healthy and you can survive. So what we want to do in the cash flow statement is we want to find out where are we burning our cash and where are we getting it from? Okay, and are we going to be in a problem next year, or are we currently in a problem due to the cash flow position? There are three main areas that can generate or consume our cash. One area is the cash flow from operating activities. So these activities include our daily business activity, like selling our inventory, paying wages to our employees, paying our bills, receiving revenue, and all of that stuff which is the result of our operations. So there might be an increase in cash as a result of the operations, or there might be a decrease in cash. So we will see what's happening. The second category is the cash flow from long-term investing activities. Now, these activities include purchasing or selling long-term assets. For example, you bought a new building for your business. That is an investing activity, and it is a long-term investing activity. When you buy that building, you're paying cash for that, so it is reducing your cash position. If you sold your long-term asset, you got the cash from it, and that will increase your cash position. So that is another category that we include, and it is separated because it is related to long-term investments. And we want to know how much cash is being consumed or how much cash do we generate from those activities. So normally, cash flows from investing activities are negative because if we are a healthy business, we should be expanding continuously. And what that means, we might be opening new locations, we might be buying new machinery. So that means we are spending cash to build those long-term assets. So usually the cash flow from investing activities is negative. From operating activities, it is normally a positive cash flow. But if you are a new business starting, so you might not be making a lot of money here, so it might be negative. But usually it should be a positive cash flow. And the third category is the cash flow from financing activities. These financing activities are actually the activities related to the investors. So you either receive money from the shareholders or you pay them. That is a financing activity. Any cash, flow as a result of these activities is the financing activity. Similarly, if you borrow some money from the bank, that is also a financing activity. Okay, so those things will be included here. Normally, if you are an expanding business, if you are a growing business, you need more and more money from the financiers, okay, which includes your shareholders and your bondholders. In order to get that money, you are using that money to buy long-term assets so that you can expand your business. So in a normal situation, cash flows from financing activities should be positive because we continuously receive money from those investors. So those are the three main areas, and then we find the net change in cash as a result of the operations. So what change did we cause due to financing activities? What change in cash flows did we cause due to investing activities? And similarly, due to operating activities. And then we take the cash from the last year's balance, and then we find the cash at the current year's end. So that is a summary of the cash flow statement. And now we're going to build it. Any questions so far? Anything you would like to ask? And is my screen visible to everybody?
Yes.
Yes, it is.
Okay.
Yes.
Now let's come to the interesting part. Building the cash flow statement. Now, the way we're going to do it is in the operating activities, cash flows from operating activities, we start with the net income. Okay. So that number comes from the income statement. So let's click here and press the equal sign, go to the income statement and take the net income right here. You see, this is the income statement and the net income for 2012 is right here, that number. And you enter, we got the net income. You can see that's a negative number, so we have actually a net loss in this year. Then we add the depreciation and amortization to the net income. Why do we add depreciation? Because we remove depreciation from our income because that is considered as an expense and it reduces our income. So we get a tax benefit, right? But it is not a cash flow because depreciation is not a cash expense. We don't pay any cash in that particular year to pay for the depreciation. We paid at the time of purchasing the asset. So there's no further cash flow due to depreciation. So in order to find our cash flows, we add the depreciation expense of this year to the net income in order to find the cash flow effects. So that depreciation expense should also be present in the income statement. Let's go and find it. Where is it? Depreciation is right here, row number 33, and we're going to take that number from 2012. So we click on that, press enter, we got our depreciation expense. Now the next item, and I want your attention here because this is important to understand. Changes in accounts payables. What is accounts payable? This is the money that we have to pay to our suppliers. So let's say that you bought some inventory of $500,000 from your supplier, okay? And you did not pay them right on the spot. So you'll be paying that next month or in the next 2 months or whenever is your agreement with your supplier. But you will have to pay it. That is a liability, okay? Now, one thing that you need to remember is that when there is an increase in a liability, it results in a positive cash flow. When there is an increase in a liability, it results in a positive cash flow. So let me show you how. Let's say the liability is the loan, okay? You borrow from the bank, and this is the current year, for example, and you had last year. So let me show you how that works. So last year, suppose that you had no borrowing, so that balance was zero. You did not have any borrowing from the bank last year. This year, your loan balance has gone to $100,000. Okay. Now, what that means is that you borrowed $100,000 from the bank. Okay. Now, what is going to be the result of this borrowing? The result of this borrowing is that you got the $100,000. So you got the cash, and that is a positive cash flow. That is a cash inflow for you. So this will be considered as an inflow, right? So you find the difference between the 2 years, okay? The difference is equal to, like, of course, very simple. Current year's liability minus last year's liability, and that is 100,000 positive cash flow. On the other hand, let's say that your last year's loan balance was 400,000. And this year, your balance has gone down to 100,000. What does that mean? How can this loan balance go down from 400,000 to 100,000? The only possibility is that you paid it. You paid 300,000 of your loan in the last year, and that means your cash flow has decreased. Your cash has decreased by 300,000 because you have paid out a liability. So that means if a liability increases, it is a cash inflow. And if the liability decreases, that's a cash outflow. All right, so here's the rule. Liability or same goes with equity. If this increases, if liability or equity increases, you get cash inflow. And vice versa. If liability and equity decreases, you get cash outflow. All right. Now, on the other hand, when it comes to assets, so if an asset increases, you get cash outflow. And why is that? Because how can your asset increase? You are buying the asset, right? You're buying the asset, and that's why you will have to pay for it. So that will result in a cash decrease. And if an asset decreases, that will result in a cash inflow. Reduction in asset means you're selling it, okay? And this will most likely result in a cash inflow. Now, keeping this rule in mind, let's look at this. Accounts payable is a liability, and any increase in a liability, taking this formula, will result in a cash inflow. So let's put the formula here, equals to, we go to the accounts payable on the balance sheet. So accounts payable is right here, row number 16. What we do is we find the difference. And you can clearly see that the accounts payable have increased, or in any increase in the liability is a cash inflow. So we find the difference, the current year's accounts payable minus the last year's accounts payable. Okay, press enter and you get $378,560. That means we got a cash inflow of this amount as a result of our increase in accounts payables. Similarly, accruals. Accrual is another type of liability, which is like, if your employees' wages are accruing for the past month or two, or your bills are accruing, those are current liabilities that you will have to pay. But for short term, like, if you have not paid the wages yet, you are actually holding your employees' money. So that any increase in accruals will result in a cash inflow. So same formula, we go and find the difference in the accruals account. That should also be on the balance sheet. So we go to the balance sheet right here. And accruals is right here on row number 18. Let's find the difference. 2012 balance minus the 2011 balance. Press enter and you find the difference. Our accruals have gone up and we get a cash inflow as a result of that increase. Now, the other thing, Lauren, okay, all right. So accounts receivable. What is accounts receivable? This is our money with our customers. which means we sold our products to our customers, but they have not paid us yet. They will pay next week or next month, but they will have to pay us. In other words, it is our money in our customers' pockets. Now remember, if our money in customers' pockets increases, that means it's a cash outflow. They are holding more of our money. Okay, so any increase will be negative, any decrease will be positive. So we're gonna do the same, find the same difference, but what we're gonna do when I press the equal, then I press the negative sign, enter the negative sign, so that it reverts the difference. So, and then I go type the parentheses and go to the accounts receivable on the balance sheet. And it is right here, accounts receivable is row number 7. I find the difference between the two numbers in exactly the same way, but I have put a negative sign over there in the formula, which means that it's going to revert the calculations for me. Okay, so current year minus last year, and then close the parentheses. What it's going to do is going to find this difference between the two, and you can see there's an increase in this receivable. And I told you, as per the rule, any increase in an asset is a cash outflow. So when I press the enter button, it gives me a negative $280,960, which means as a result of increase in our accounts receivable, like $280,960 additional dollars of our money are stuck in the customer's pocket. So that's a cash outflow. Same goes with inventories, because inventory is also an asset. So I will do the same thing, equal to a negative sign and start the parentheses. Okay, I go to inventories, and where they are right here on the balance sheet in row number 8. So I find I click on the current year's balance and minus the last year's balance, and then I close the parentheses and press enter. And you can see that there's also a cash outflow as a result of the increase in inventories. So we're good now. That is the only items in the operating activities that we have. So let's find the result. So what I'm going to do, I'm going to find the sum of all of these numbers, which means, like, all the negative numbers are already negative, positive numbers are already positive. So if I find the sum, it will add the positive numbers and subtract the negative numbers and give me the final result. And you can see that there is a negative number, so it means our operations net cash provided by operating activities is a negative number. So we have burned $164,176 as a result of our operations. So we're not only losing money in our operations, as you can see on the income statement, our EBIT, which is the operating income, that's a negative number. We're not only losing money, but we're also burning cash in the operations. So there could be something wrong with this company's operations, and we may want to dig deeper. And that is probably the reason that the stock price has gone tremendously down from, you can see, from $8.5 to $2.25. That is still an indication of what's happening in the company. All right. Now the next item is cash flow from long-term investing activities. Now, the only long-term asset that we have in this business is gross fixed assets, as you can see, the fixed assets. Now, in this financial statement, in this balance sheet, they have combined, probably they have different types of fixed assets. They might have some cars and machinery and building or whatever they may have, but they have pooled all of those fixed assets into one account, which has made our job easier. If they had listed all of those assets separately, we would have to find that difference separately. But right now, they have pulled everything together, so that's good for us. What we're going to do when we find this difference, the long-term assets, so what we find is additions to plant, property, and equipment. Let's see, that will be equal. And remember, it's an asset, so any increase in asset will result in a cash outflow. So the same formula applies, equal to minus, and then the parenthesis, then go to the gross fixed assets account right here, gross fixed assets, and current year's balance minus the previous year's balance, and then close the parenthesis. And you can see that we have burned $711,950 in the long-term assets. What that means is that we bought new long-term assets and probably we're expanding. And that could be one of the reasons that our income is negative, because we're spending a lot of money to expand and get ready for future income. So because that is the only item in the long-term investing activities, so we don't have to add anything else. The net cash flows from investing activities is the same number. Okay, so we have got the cash flows from investing activities. All right. Now, sometimes what may happen is that the balance sheet will not give you the gross fixed assets amount like we have got in this case. They will simply give you the net fixed assets account. What is the next fixed asset? When we take the gross fixed assets and remove the accumulated depreciation, like all of the previous year's depreciation added together, and we remove it from the gross value, which is the amount that we paid to buy these assets, and we remove the depreciation, we get the net fixed assets. So they may give you, instead of the gross fixed assets, they may give you the net fixed assets. If that is the case, you can find the investments or the cash outflows as a result of the investing activities slightly differently. What you will do is that you will find the difference between the two balances of the net fixed assets, and then you will add the depreciation for this year. Okay, and that depreciation will come from the income statement. Just to double check it for you, we've already done it here, but just to double check it, let's see what we do. Equals to, we find the difference between the net fixed assets. So where are they? Net fixed assets right here. So current year minus the previous year. Okay, and then we add the depreciation. So that depreciation should be coming from the income statement. Where is that? Row number 33. We add this value. All right, so it is the same value as we have got here. The only thing is that we ignored the negative sign, so you can add that negative right here minus in the parentheses, and then a parenthesis right here, so it will make the answer negative. But just in case, if they do not give you the gross fixed assets, but instead give you the net fixed assets, you can still find the cash flows from the long-term assets in this manner. You find the difference between the net fixed assets and then add the depreciation. Anyway, we don't need that. We have already done our calculations right here. Now we move to the next part, which is cash flows from financing activities. And as I told you earlier, financing activities include, any cash inflows and outflows to investors. Okay, those are the shareholders, the bondholders, the banks, all those guys. Okay. And again, this is included in the liability side, and as per the formula, the rule that I told you, if liability or equity increases, you get cash inflows. If decreases, you get cash outflows. So let's check. Now, notes payables, it is in the current liability section right here, notes payable. It's a current liability, but remember, notes payable is actually a short-term borrowing from a bank or any other entity. So you borrow it for a short term, maybe 5 months or 6 months or 1 year, and you just want to return. It's not a long-term borrowing for 5 years or 10 years or whatever, but it is still a liability. The bank is an investor. The bank is investing the money in your business, and they are expecting a return on that. Okay, they are expecting an interest on that investment. So any increase, you can see that you have borrowed, like last year your balance was 145,000 and this year is 524,000. That means you have borrowed a lot more money from the bank on the account, on the notes payable account. So that means it should result in a cash inflow. Okay, increase in the liability is an inflow. So let's go to that section, and right here, changes in notes payables equals to the current year's notes payable minus the last year's notes payable. Right here, row number 17, current year minus last year. Am I doing the correct? Yeah, okay. So earlier I was not doing showing you the correct number. Notes payable right here. So current year minus the last year. Okay. Enter. Oh, something went wrong. Okay, let's do it again. Equals to. We go to the notes payable. This one. And current year's balance minus the last year's balance. And that comes out to be. Oh, it's already done. Nothing wrong. Okay, then we go to the long-term debt, say because the debt is also long-term debt is also a liability, so we apply the same rule. So the current year's long-term debt balance, it should be on the balance sheet, and right here in row number 20. Current year's loan balance minus last year's loan balance, as you can clearly see, the loan has increased, which means we borrowed more, and that should result in a cash inflow. And that inflow is 400,000 additional inflow as a result of the borrowings. Now, payment of cash dividends. Now, if we pay dividend to our shareholders, of course, that is a cash outflow. It reduces our cash. So we can take that from the statement of owner's equity. We make it equal to in statement of owner's equity. Here is the dividend to paid to common stockholders. That is 11,000. So we take this number. Okay, and that's a negative number because we paid out to the stockholders. Now, anything else? I mean, look at the equity, for example, right here. If you look at the common stock, there has been no change. So there's no cash flow as a result of that. Retained earnings, but that has already been taken care of somewhere else. So that doesn't matter. Now, that's the only thing that we need to consider. If you find the sum of these numbers from the financing activities, you get the net result. So, and as I previously told you, the usual result should be a positive number. So that means we got $825,808 from the financiers in order to finance that business. And where is that coming from? It is coming from the short-term borrowing in the form of notes payable, and long-term borrowing in the form of the long-term debt. Okay. Now, what is the net change in cash due to as a result of this year's operations? Of course, we generated 825,000 from financing, but we spent 711,950 in investing. And we also burned 164,176 in operations. So we add all of these numbers together, and that will be the net change. So equals to the balance from the financing activities plus the balance from the investing activities plus the balance from the operating activities. Press enter and you get that number, 50,318, but that is a negative number, which means that overall we have, despite of so much of borrowings, $825,808 of borrowings, we still have reduced our cash balance by $50,318. And we can see that, we can check that. Now we take the cash at the beginning of the year. So the cash at the beginning of the year should be equal to the cash balance of the last year. It should be equal to the cash of 2011. And what is that? That is right here. Row number 6, cash of 2011 is 57,600. Okay. And what should be the cash balance at the end of the year? Of course, we had 57,600 last year, but we burned, so I'm adding that negative number. We burned 50,318 this year out of that cash balance. So our new balance should be $7,282. That is our new cash balance. Okay, let me make it proper for the accounting formatting. So let me do it that way. Okay, now what that means that we have got $7,282 in our cash balance this year. And if you want to double check whether you have done your calculations correctly or not, you should check this number should be equal to the cash balance on the current year's balance sheet. So this is 7,282. Let's go to the current year's balance sheet, 2012. That is the same number for cash. You see, 7,282, which means our cash flow statement has been done correctly. So that's it about building your cash flow, and we can clearly see that we're burning cash in our operations. So probably we need to double check and see whether it is a result of our expanding business, or maybe we are not making sales, or our expenses are too high or something like that. So we need to dig deeper into that. And we are purchasing assets, long-term assets, so we're burning cash in there, and we are borrowing money from the banks and debt holders, for example, and that is giving us the cash inflow. But if we are going in this speed, like we're burning cash in our operations, probably next year nobody's going to lend us money. So those borrowings may not be available. And you can see that we're already too short on the cash balance. Like for a business of this size, $7,000 cash is just nothing. It's they cannot have like maybe a 2 weeks of operations with this cash. So they need more cash. And where should that cash come from? Are they going to borrow more, or are they going to issue new shares, or what are they going to do? This is something that needs to be considered. So before we jump on to the next topic, I will stop for some questions on this topic, and then we'll take a 5 minutes break.